Welcome to the Central Florida Land Vlog. My name is Jason Toll with NAI RealVest. Today we're talking with Peter Hilera. Peter is a CPA and he's a partner with the Witham accounting firm. We're talking about tax liabilities faced by long-term property owners when they go to sell their property. This is segment 2 of 3, and we are talking about the tax liabilities when sale proceeds are passed on to the next generation. So let's let Peter pick this up, and thanks for watching. Okay, the second scenario is we have a long-term property owner who wishes to sell their real estate, and they either have sufficient tax planning in place, estate planning, or they need estate planning. And they're thinking about the liability of transferring the proceeds onto their descendants. How will the next generation handle that money? And so how would you, it's a very broad question, but in general, how would you advise a client to approach a situation like that?
Yeah, that is a broad question, and it really has to do with what their desire is to help the next generation along, of course. So I think the first thing that I think that individual will need to sit down and figure out is, if I have enough liquidity or I have enough investments or I'm doing okay, and I would like to transfer this asset to some of my children or their descendants, how much would I like to transfer? What is the purpose of that, and what are they going to do with it? I think would be one important thing. The other thing, from a purely tax perspective that you have to think about, it's really what gifting that individual has done during their lifetime and how much of the exemption they have left. Obviously, the gifting scenario is also very favorable this year so far, and it has been favorable. An individual, I believe, can give about 11.5 million or 11.6 million away without incurring any gift tax liability. And that would be one member of a couple. It would be the husband. The wife could bring that together, so it's over $20 million that can be gifted. So I think the first thing is that gifting and the planning that you're going to do. Second is understanding that once you transfer that piece of property from a gift tax perspective, if it has a very low tax basis, you are shifting that capital gain or that tax obligation to the recipient, right? So once you can realize that that's going to be the tax impact of doing that, that will be helpful. Also, I think you have to plan and think about overall how many assets you have and how much you want to get out of your estate currently. Again, you mentioned briefly that the environment may be changing. There's been a lot of talks about taking that $11.5 million exemption all the way down to maybe $3 million or $3.5 million starting next year or possibly this year. So I think that's one issue that if you really want to figure out the best and most efficient way and when you need to do it, you need to start planning for it now.
I've said it before and I will say it again, that competent tax advisory, having a competent tax advisor on your side will be crucial, especially coming up.
Yeah. Another thing that people often miss is not the gifting part or the estate part, but also the charitable giving. There are certain vehicles, trust vehicles, that if you have highly appreciated land, you can give a charitable contribution based on a certain factor to a trust. That trust can turn around and sell that piece of property tax-free. It can guarantee you a return of your funds over a period of time, and then when you pass away, the remaining funds go to the charity that you have selected. So there are various ways not only to do estate planning, but also charitable giving that will allow you to have some income stream over a period of time and then help whatever charity you choose after a certain amount.
I like to think that there's plenty of people out there who have these charitable giving plans, and this could be a terrific benefit to them.
It is.
Thanks for bringing that up.